Today, folks, I have my 318,000 juicy passive income collected portfolio set up in a hyper-specific way that I want to get across to you in this video as clerically as I can, because the fools, the clowns across the spectrum of the internet were telling you SCHD, these dividend stocks are garbage. You need to be a total return investor, and here they are, everything money. Guess what? Today announcing they're buying it, baby. Not when it was cheap 10 months ago, but of course when it's at all-time highs. We're going to compare the broader market performance with the S&P, the TSX, what's going on with tech versus the interest rate recovery plays that I am so boldly placing bets across. We're going to talk about bank recoveries. People, man, I told you to buy these things when they were cheap. But no, you didn't listen. Instead, you've been running around with a squirrel, like a squirrel without a nut, looking at these things like Nvidia, Palantir. These are the things that cause the most affliction, because even Jim Cramer is scared to talk about this shit on his call, because the Palantards are reigning supreme, and they'll bring the reign of terror and, you know, their little soapbox, you know, like, what are they, keyboard warriors going at you, right? So you gotta be a little careful with what you say, but we're gonna do this unfiltered, baby. I got nothing to care about. You shit in the comment section about me all you want, because I be winning, baby. I have been strategically really sitting down and paying attention to the markets in a way that have still continued me to lead out performance through a very boring strategy of ETF and passive investing. Now, how do we do this? How has this worked out to our favor? Because it hasn't worked out with SCHD. I'll tell you that right now. SCHD has been the lagger of my portfolio, and I am a total return-oriented investor. I like a combination of dividends and growth. I believe both can really benefit a portfolio. Hell, if I was 20 years old again, I probably wouldn't even care about dividends. I'd be investing in total returns because I need growth. That's how I started my investing journey. But as I've aged, I like using it to obviously keep some preservation in the portfolio. And in retirement, with people like my parents, I don't even put them 100% in dividend stocks, because I recognize that when tech, the S&P, starts to perform, there's nothing wrong with pulling 5% out of a 20% gain we've seen this year, folks. 5% is the equivalent of collecting a dividend. There are less taxes on capital gains for the most part than there are dividends, right? So the idea is, hey, if the market does well, you want to go on a vacation, pull some money out. The market doesn't do so well, use your dividends, keep paying your bills, and wait till the market does well. You can take advantage of all of this. There isn't a one-size-fits-all shoe in this journey, to the point now where I'm laughing my ass off at everything money. This is what they were saying literally 10 months ago.
They want to attract investors, but you need to be the better investor. You need to be the smarter person out there who says, wait a second, is this the best use of your capital? Warren Buffett just said the other day, the day Berkshire pays a dividend is, in so many words, basically, that's not a good thing, because it means we have no other reinvestment opportunities. It's the best investor all the time. He knows the best way to and at that point that happens, guess what happened to the stock price? It would plummet. And then, you know what I'd say? Start buying back shares. Cancel the dividend, start buying back shares. What?
This guy, oogling Buffett, who has been outperforming the market, that could just put his money with Berkshire Hathaway, could just put it in the S&P 500 and pull gains as a spoiled, like, millionaire inheritor, which unfortunately most of us did not get a trust fund like this guy, a mere 10 months later, not 10 months ago when SCHD was cheap, when we were buying it, but no, today.
For all you dividend lovers out there, I have some exciting news. I'm going to be putting about 25% of my net worth into SCHD. Now, you may recall, if you've watched...
I may recall that you shit on it a lot. You didn't like it. You thought it was tax inefficient. And here you are writing cover calls and buying SCHD, making it like what?
Channel, we have a past video that we did talking about SCHD.
Yeah.
Recently, I decided I've changed the way in which I'm handling my money. I've got a lot of business. I've got about 1,000 apartments and growing.
Oh my God, shut the fuck up. It's like... Listen to this guy, 1,000 apartments and growing. Things are great. Now I want cash flow. And honestly, who gives a shit? It really doesn't matter. These guys are clowns on the internet like the rest of us are. Don't take anything I say as financial advice. It's just my tomfoolery and me dicking around on the internet, just trying to show you guys like a squirrel without a nut, trying to just capture something that shows that, you know, an average Joe Blow who made less than 50K a year can become a millionaire through prudent investing, right? Like, just being very cognizant and safe, and, you know, paying attention to what's going on in the market, not like the Palantards that we'll get to in a moment, right? I know, I'm sorry. I wanted to throw shade because I know they're going to be the keyboard warriors down there just going nuts, you know, just shitting on me like they want to. I know you're out there. I love you guys. But take a look at this, because this is what I find so interesting. Like, I have set my portfolio up for basic interest rate sensitivity recovery. That's where I'm at. I bought these ETFs in a very specific way because I think there's more value in the lower half of the S&P than there is in the upper half today. That's why we're seeing turbulence in a lot of the tech companies, right? So if we take a look at the 5 days, my triple leverage ETF continues to crush. The S&P has now returned 3.3% just this week, breaking what could potentially break the spell, the Halloween curse that comes every September, where the market tends to find a bottom by October and then recovers into the Santa rally. We are up 3%. So congrats if you bought the S&P this week and you continue to cost average when everyone was fearful. You crushed it, right? SCHD is only up 1% this week. The utilities are up almost 3%, and VDY is not doing that well this week. But if we continue to zoom out over the last month, what a stark difference. 3x leverage real estate up 24%. The S&P still, over the last month, only just recovering, still up only 3%, whereas everything else has been crushing it. SCHD is up 3.3, utilities up 5, VDY up 5. We take a look at the last 6 months. Again, things get very interesting because over the last 6 months, you got to remember, most of the S&P gains only came in the first bit of the year. But over the last 6 months, S&P's only up 9%, Schwab's up 5%, utilities are up 22%, VDY's up 8%, and triple leverage real estate's crushing it, right? So why is SCHD lagging so much, guys? Well, I have some speculation on it because obviously, I still think as the interest rate cut recovery begins, a lot of stocks like Home Depot, there's a lot of companies in there that will start to benefit indirectly that I just don't think a lot of people are thinking of when they think interest rate cuts. And that's why I started leveraging into utilities and real estate, because I really feel like that's every idiot investor in the world who's like, hey, light bulb, interest rate cut, real estate does well, utility does well, the debit companies do well. You don't pay much interest anymore. It just seems like the market always lags to picking up on that, and that's exactly what we're seeing here, right? And then obviously the FOMO will start to bake in at some point. Now, if we take a look, tech has done very well this week. We see a bit of a recovery, but again, I have some speculations on Apple and Microsoft. They have to start proving their value, and they're very expensive today, right? But I'm not going to stop buying them because of that. I'm still cost averaging into the S&P. I didn't know Nvidia was going to pop up 15% this week. Google's really coming back. I told you guys this week, Google, Meta are still my two favorite plays, but that doesn't stop me from cost averaging into the spectrum, right? Hell, I mean, you take a look here, and even Home Depot is starting to bounce pretty good this week, but for the most part, guys, the S&P is sitting in a really odd stuttery place, right? Like, it's been testing all-time highs here. We'll see if we can break through them, but we've been mostly flat for the last 2 or 3 months coming out of summer. So let's see what happens, right? But I'm still placing my bets on companies within the TSX. It's why I'm still buying VDY. It's why I'm so fixated on getting into real estate and utilities, because I don't know what's going to happen with tech. I have no certainty of it. I'm not going to sideline it. That's why we have the S&P, but I'm going to start strategically trying to outperform by placing my bets within companies that I think will do better in the near term. And I'm doing it through ETFs like VDY, because VDY heavily concentrate discounted companies like Toronto Dominion Bank that are unjustly beaten into the ground by things that were largely out of their control. Obviously, when it comes to drugs, drugs is such a weird statement if you don't know the TD lore, but obviously they're getting one of the largest bank fines in history because of money laundering. But still, I don't think it materially is going to affect the long-term aspect of their business. And guess what, guys? For the last couple quarters, what did I tell you? This thing's a buy. This thing's a buy. You should be buying it here. This is the dip buy of an opportunity of a lifetime, right? This is why I've been buying VDY, because it's 10% of the holding next to Royal Bank, which Royal Bank has crushed it. BNS, oh, this is a buy. These are like Pokemon cards. You should collect them while they're paying out historically high yields, guys. And what happened? I don't know what happened, but they jumped up a hell of a lot, didn't they? Their returns are starting to look pretty damn juicy, aren't they? Especially when you tapped in the fact these things were paying out unbelievable yields they can afford. So that is how I feel about the setup of my portfolio. I have been able to take advantage of these stocks through buying ETFs in a very weird, boring way. This looks so boring. I'm not collecting a huge yield by any metric at 2.32%. But I am getting a total return that continues to outpace the market. And I'm strategically, obviously, making those hyper-focused bets. Why we triple leveraged real estate. Because if you believe in yourself and you believe these things are going to come true, I don't want to be the idiot that sidelined my beliefs to find out that I was correct and I didn't make any damn money off of it. So the worst feeling is knowing something and not taking advantage of it, folks. So what do we know about tech? Tech is very uncertain in the short term, right? Long term, I still think the technological revolution is going to change everything. What those tech stocks end up making up for the S&P 500, we don't know. We don't know if Tesla self-driving becomes a dominant factor in the next 5 years and it reigns supreme and becomes a top 10 company, well, in the top 5. We don't know what Amazon's doing. We don't know what cloud computing or quantum computing or ChatGPT ends up doing, and that's the fear, right? Because all of that stuff is baking into the value of these companies, yet we don't know what the revenues are actually going to look like. We don't know what the growth is going to look like, and it's starting to taper off a bit, right? This is the AI bubble that so many people have been betting on, and it was a great bet throughout the beginning of the year, but something tells me it's going to be a more volatile bet in the latter half of the year, and that comes into play with Palantir too, right? We're starting to get hype followings in these companies, and I think Palantir is like the exact representation of where Tesla was in 2019. The question is, can Palantir become the next Tesla? Obviously, we're not going to be talking about this company becoming a top 10 software like company like Google is or like Microsoft is. That's not going to happen. Tesla, that was a once in a lifetime kind of stock where it runs into the $1 trillion value range, right? But that doesn't not mean that this can't run up to a couple hundred Bs, right? But what would cause that to happen? Because right now, this is one of the most expensive tech companies out there. It's one of the most expensive software companies you'll come by, which means you're taking on absurd forward risk in your portfolio if you're buying this stock today. And it's to the point now where I think it's hilarious because if you didn't know, what did Jim Cramer say on Mad Money when the guy called in to ask his thoughts about Palantir? He literally interrupted him and said, "It's a cold stock and I don't have anything to say about it," and hung up. Like, what the fuck? Anyone catch that on Mad Money September 11th at 50 to 55 minutes in the show? And that's because I think Jim Cramer doesn't want to get the Palantards lined up on their little soapboxes and becoming their little keyboard warriors like the Tesla cult following was. I mean, we were all a part of the Tesla cult following. We knew what it was like, and it's why I took profits. It's why I got out, and it's why I only recently traded it, made some money, got out again, because there's too much uncertainty for the valuation into the future. And that's kind of where Palantir is at right now. They're at a pivotal junction where you're either going to, if you're buying it today, you're taking on the most risk that you could have taken on in the last couple of years of the company. And you're sitting in a position right now where you got to ask yourself, what does the growth look like moving forward? Because you can't justify a 200 times multiple at a 20 in the 20s revenue growth, 20 percentile range. You need to be in the 30 to 50 percentile range. And if Palantir can get there, this stock is going to be a darling. It's going to get in the S&P. You're going to have ETFs buying this thing. You're going to have an exact Tesla moment when Tesla joined the S&P. You're going to have growth plus new investor money. And that is a perfect storm for just excelled returns. However, they have to achieve this. They cannot afford not to achieve this, right? Because they're sitting at a point right now where Palantir is trading at the same market cap value as the likes of Constellation Software. Constellation Software, if you notice, is doing $9 billion in revenue versus Palantir's measly $2.4 billion. And it's growing in the 20 percentile range. It's still an expensive company. I mean, these are all expensive. Software companies are just expensive. But these companies are still cheaper than Palantir, right? I mean, look at Shopify has been trading in the 20 percentile growth range, and it's been making $7.7 billion, almost at the same valuation as Palantir. So you have to understand, if Palantir was growing at the same rate as these other companies, this one specific stock is trading at like 3 times the value. So there's going to have to be a lot of justification, and no one is saying that can't happen. I am not against Palantir in any metric as much as I'm bearish on it. I'm leaning in the direction of bearish because I don't understand it. I see the partnerships with Microsoft. I see the backlog. I get it. It is a solid foundational company that was the buying opportunity of a lifetime if you bought it in 2023. Today is a very different story from the speculation standpoint, but time will tell. It is going to be a fun story to watch, and I will obviously be paying attention to it like a hawk as I pay attention to Tesla and all these other companies that tend to do very well. I mean, Constellation Software also, like, what a crazy company. I don't know if you guys have ever followed this story. Diversified, it's a diversified software company, and look at it. It's up 32% year to date. The 5-year returns have just been maddening, and it trades at like half the valuation of almost. Keep in mind, I think this is a Canadian, so it's probably less market cap value than Palantir maybe, because Palantir is 80 billion US, right? And this is 90 billion CAD. So Constellation Software is actually cheaper right now from a market cap perspective, and it makes more revenue than Palantir. It's just an interesting take. Otherwise, to round the story off here, guys, like I said, I am not tech oriented. at this moment. Obviously, I'm not. I do not care what Palantir does. I don't really care where Nvidia is going. I can't wrap my head around the future of the growth. I don't know what AI looks like in the future, making Microsoft very expensive, Apple trading at way too high multiples. If I'm going to buy tech today on an individual basis, it's going to be Google. It's going to be Meta for sure. Of course, I'm going to keep cost averaging to the S&P 500. But when it boils down to it, guys, interest rate cuts equal more cash flow for companies that have largely been hit by higher interest rates. We're going to spend the next year or two seeing those stocks likely perform exceptionally well. And in the meantime, if tech does continue to do well and post and crush earnings, guess what? I own Palantir. It's now going to be in the S&P 500. Not yet. I'm not buying it yet, but it's going to make its way in there. And if it keeps performing, I get the growth. I win no matter what. That's how you do it, baby. And I'd love to know what you think in that comment section below.